Welcome, everyone, to a very special edition of our show. We're actually kicking off a brand new series today, and we are calling it The Deep Dive of Sri Lanka Investment Market.
That's right. And it's going to be an interesting one.
Yeah, totally. So today, your mission, well, I guess our mission really, is to kind of step into the shoes of an independent forensic equity analyst. We are partnering with the analytical framework of Optivest Investing Sri Lanka for this.
Exactly. The goal here is to be a vigilant protector of retail shareholders in Sri Lanka.
Right. Because we really want to look past all that, shiny hype of market narratives and just analyze the cold, hard financial reality of listed hotel companies.
And to do that, we have a pretty massive stack of sources to get through today.
Oh, yeah. We got a lot of paper here.
We're working from a forensic case study overview called Unmasking the Narrative. And alongside that, we have the official annual and interim financial reports for TAL Lanka Hotels PLC.
Which, for those who might not know the corporate name, that's the company that operates the Taj Samudra Hotel in Colombo.
Right, the Taj Samudra. And we are analyzing their data spanning from 2020 all the way through to December 2025.
But before we just start tearing into these balance sheets, we should probably lay down the ground rules for this kind of forensic analysis.
Yeah, let me just set the baseline for our approach today. As an independent forensic equity analyst, the methodology here is strictly objective.
Right.
It's data-driven, and it's completely impartial. We are not providing financial advice, and we are not endorsing any specific viewpoints from the sources.
No market positions being taken here.
Exactly. Our sole purpose is just to convey and analyze the raw data contained in these original source materials. We want to help you learn how to independently read and interpret financial statements.
Okay, so let's start with the story that's kind of dominating the headlines right now. Because if you open any financial news feed, the prevailing narrative is that visitors are finally returning to Sri Lanka in droves.
You see it everywhere.
Yeah, like we're seeing all these stories about a massive tourism recovery. And because of that, there is just this unbridled optimism surrounding the hotel sector right now.
And, sector narratives like this, they spread through the market ecosystem with incredible speed, especially during economic recovery periods.
Oh, for sure.
Hotel companies naturally become the focal point. You see them featured heavily in broker reports. They totally dominate investment panel discussions. And, that enthusiasm completely takes over retail investor forums.
Well, I mean, it makes sense, right? You walk into a luxury hotel lobby right now, and there is this overwhelming expectation of prosperity.
Right, the visual cues.
Exactly. You see the polished marble floors, the chandeliers, the bellhops rushing past with luggage, and it feels like a money-making machine.
It does.
And as observers, we tend to just assume that physical, bustling activity directly equals bottom-line profitability. We just trust what we can see with our own eyes.
Which is exactly the trap. That visual experience is quite literally designed to project absolute financial health.
Right. They want you to feel that wealth.
Exactly. But the danger for retail investors is relying on that sensory summary, or trusting a promotional headline that screams about a 50% increase in tourism.
Yeah, without checking the math.
Right. And broker research and advisory commentary, they have their place, but you really have to understand their underlying function in the ecosystem.
Which is mostly selling the upside, right?
Basically.
Okay.
They are generally built to identify growth opportunities and showcase potential. And consequently, they often just gloss over severe balance sheet risks, looming debt traps, and questionable corporate governance decisions.
So it's kind of like, okay, think about it like this. Buying a hotel stock just because tourist arrivals are up at the airport is a lot like investing your life savings in a local bakery simply because people love eating bread.
That's a great analogy.
Right, because the logic seems sound on the surface. People eat bread, the bakery sells bread, so the bakery must be rolling in cash. But what if the cost of flour has tripled, or, I don't know, their commercial rent is secretly bankrupting them behind the scenes?
Exactly. Think about the actual mechanics of that bakery. What if the massive commercial ovens they use cost millions of rupees and they bought them using a variable rate loan?
Oof. Huh.
Top-line macro trends, like a surge in general tourism, they do not automatically translate to bottom-line profitability for an individual operator.
Right.
Retail investors must independently verify these market claims. You have to examine the actual official disclosures.
Okay, so if the macroeconomic narrative is overwhelmingly positive right now, what do the actual books say? Let's do exactly what we are preaching here and open up the official disclosures for TAL Lanka Hotels PLC for the financial year 2024/25.
Okay, let's look at the numbers. And honestly, the forensic data presents a stark contrast to all that market enthusiasm.
I'm looking at it now, and yeah, it's wild.
We are looking at the FY 2024/25 results, and on paper, they generated a top-line revenue of 3.47 billion rupees.
So a retail investor sees 3.47 billion in revenue and naturally assumes the company is just thriving.
Right. But then you scroll down to the bottom line.
Yeah.
Despite that massive revenue figure, the company reported a net loss of 327.8 million rupees.
Wow. Over 300 million in losses.
Yes, that is the revenue illusion at work. A large top-line figure often masks a really bleeding operational core.
And it gets worse when you compare it to the previous year, doesn't it?
It does. When we break down the comparative data, the picture darkens considerably. That revenue of 3.47 billion, it actually represents a decline.
Wait, really?
Yeah. In the previous year, they brought in 3.73 billion rupees.
So the company's revenue is actually shrinking during a period that's heavily marketed as a nationwide tourism boom.
Exactly. And while we have shrinking revenue, the cost side of the ledger is moving in the complete opposite direction.
Yeah, let's look at these costs.
Yeah.
Because finance costs ballooned to 347.1 million rupees.
And then there's the operational side. Running a five-star hotel requires a massive workforce,
Right.
And those staff costs soared. They neared 1.1 billion rupees for the year.
1.1 billion just on staff. And then, okay, let's look closely at this marketing expenditure line item, because this is the part that really stood out to me. They actively increased their marketing budget during the same period.
Yes, they did.
Wait, how do you spend more money on marketing but generate less revenue during a period of macroeconomic recovery? I mean, I see that as a glaring red flag for operational inefficiency.
It absolutely is a red flag.
You are shouting louder into the market, but fewer people are walking through the doors.
Exactly. When your marketing budget goes up, but your revenue goes down in an expanding market, your return on investment for that capital is effectively negative.
Yeah, you're just burning money at that point.
And this combination we are seeing, falling revenue, rising fixed operational costs like that 1.1 billion in staff expenses, and rising debt service with 347 million in finance costs, it creates what we call a classic margin squeeze.
A margin squeeze.
Right. The capital required simply to keep the doors open is rising much faster than the capital coming in.
Which is terrifying if you own the stock.
Exactly. This financial reality completely shatters the optimistic tourism narrative, at least for this specific property.
Okay, so the FY 24-25 numbers are alarming, but, they are in the past. To see if management managed to stop the bleeding, we need to advance the timeline. Let's look at the most recent interim numbers from our stack.
Right, so we have the 9-month interim report ending December 31st, 2025.
And I pulled this expecting to see a turnaround. Maybe a bump for the winter season, given the wider tourism trends we keep hearing about.
But that's not what happened.
No. Instead, we see further deterioration. The loss actually widened to 330.4 million rupees.
And just for context, in the exact same 9-month period the prior year, the loss was 215.6 million.
So the financial hole is just getting deeper, and the rate of decline is accelerating.
It is. And two devastating metrics from these interim sources reveal the underlying cause of this acceleration.
What are we looking at?
First, we see a 17% increase in finance costs compared to the prior period.
Okay, so debt is getting more expensive.
Right. And second, and this is significantly more alarming for the company's long-term health, there is a staggering 99% collapse in finance income.
Wait, a 99% collapse implies the money just, vanished.
Essentially, yes.
Because finance income is typically the interest a company earns on its cash reserves, right? The money sitting in institutional accounts.
Exactly. And a drop of that magnitude tells us those cash reserves have been entirely depleted. The company has virtually no liquid safety net left that's generating interest.
Wow.
Meanwhile, that 17% increase in finance costs, it indicates they are actively borrowing more money, likely at higher rates, simply to sustain daily operations.
So for you listening, if you're building your investment knowledge, the relationship between those two specific numbers is vital. You have finance costs rising because you are taking on more debt,
Right.
while your operational income and your cash reserves are simultaneously falling. You reach this mathematical tipping point where you are borrowing money just to pay the interest on the money you already borrowed.
Exactly. You aren't investing in the hotel's future anymore. You are just feeding a debt spiral.
A debt spiral. That's a great way to put it.
And when a company enters that kind of spiral, traditional lenders eventually cut off access to new capital. They just say no.
So if the banks stop answering the phone, how does a company keep the lights on? They obviously needed a lifeline to maintain operations.
They did. Which leads directly into the corporate restructuring that they executed in June 2025. And this is where retail investors really need to pay attention to corporate actions.
Okay, so what exactly happened in June 2025?
The parent company, which is TL Hotels and Resorts Limited, intervened with a major capital restructuring.
A bailout, basically.
Basically, they took the related party borrowings, which is essentially the debt the hotel already owed to its own parent organization, and they converted it into equity through a private placement.
Okay, let me break this down with an analogy because I think this is super important for retail investors to visualize.
Go for it.
Think of the company's total equity like a pizza. You and a group of retail investors own a specific slice. And let's say that represents your percentage of the total pie.
Right.
Suddenly, management decides they need to wipe out a massive debt on the books. So they bake extra dough onto the other half of the pie, issuing those new slices entirely to themselves.
Exactly what happened.
Your physical slice didn't get physically smaller. You still hold the exact same number of shares in your portfolio, but your percentage ownership of the total pizza just shrank.
Yep.
Your voting power and your proportional claim to any future profits have been permanently diluted.
And the hard numbers from the official disclosures illustrate the severity of that dilution.
How bad was it?
Before the private placement, the public shareholding percentage stood at 17.24%.
Okay.
But after the parent company issued themselves new shares to absorb the debt, the public shareholding was reduced down to 14.01%.
Man, the total pool of shares grew massively, but the public investors received none of it.
None.
So retail investors effectively paid the invisible price to bail out the company's historical debt mismanagement. You hold the stock expecting the tourism recovery to boost your portfolio, and instead your ownership stake is just shrunk to satisfy the parent company's balance sheet.
Which is why reading the footnotes and understanding the mechanics of corporate actions is just as critical as analyzing the top-line revenue. You can't just look at the big numbers.
Definitely not. But I actually want to play devil's advocate here and challenge our own analysis for a moment.
Sure.
Are we being too pessimistic? Because I'm looking at another page in these reports, specifically the cash flow statement from the FY 2025 report, and I see a massive positive indicator.
I think I know what you're looking at.
Yeah, the company generated a positive operating cash flow of 376.1 million rupees. So how can a company report an accounting loss of 327 million, but simultaneously generate 376 million in positive cash flow?
It's a great question, and you have isolated the exact silver lining that optimistic broker reports will feature prominently in their promotional summaries.
Right, they'll just point to the cash and say everything is fine.
Exactly. But to truly understand a company's health, we have to bridge the gap between an accounting profit and actual cash flow. The key lies in understanding non-cash expenses.
Okay, so what's the biggest non-cash expense on this ledger?
Without a doubt, it's depreciation. In FY 2025, the company recorded 318.6 million rupees in depreciation.
So how does depreciation actually work in this context? Because 300 million is a huge chunk of change.
Depreciation is basically the accounting mechanism used to allocate the cost of long-term heavy assets over their useful operational life.
Right.
So when a hotel purchases, say, a new elevator system or industrial kitchen equipment or luxury furnishings, they don't expense the entire cost in year one.
Because that would tank their profits for that specific year, right?
Exactly. They spread that cost out over a decade or more. When they claim that depreciation on the income statement, it significantly lowers the accounting profit. But, and this is the crucial part, it doesn't represent an immediate present-day cash outflow.
Because the company already paid for that elevator years ago.
Precisely. So when you add that non-cash expense back into the operational equation, the cash flow suddenly appears robust and healthy.
It creates the illusion that the company is actually doing fine. You know, they have cash on hand, so the massive loss looks like it's just a paper accounting trick.
We actually call this the capex trap, and it is incredibly dangerous for retail investors to ignore.
The capex trap. I like that.
Hotels are fundamentally asset-heavy businesses. Depreciation is not merely a theoretical accounting entry. It is a mathematical representation of physical decay. It is the ghost of future bills.
The ghost of future bills, yeah, because every time a guest rolls heavy luggage over the luxury carpet in the hallway, or every time a bed spring compresses, or every time the central air conditioning strains during the peak summer heat, that is depreciation happening in real physical time.
It is. And eventually, that ghost comes to collect. To remain viable and competitive in the luxury hospitality market, management must eventually deploy real, hard cash to fund renovations. They have to replace worn assets and modernize the facilities.
Right.
And this recurring investment requirement is known as maintenance capital expenditure. If a company's operating cash flow only appears positive because they are recording massive depreciation, it often signals they are steadily wearing down their physical assets without reserving the necessary cash to replace them.
Wow. So the positive cash flow we see, that 376 million, it isn't a sign of thriving operations. It's the result of deferring the future of the building. You only have cash today because you are neglecting the maintenance required for tomorrow.
Exactly. And there is actually a second major factor driving the wedge between the cash flow statement and the reported accounting losses.
What's that?
The foreign exchange impact. We call it the FX factor.
Ah, right. Because Sri Lanka has experienced severe currency volatility over the last few years. How does that macroeconomic reality specifically impact the balance sheet of this hotel property?
Well, TL Lanka Hotels holds a significant amount of USD-denominated borrowings.
US dollar debt. Okay.
Right. We have to look at the mechanism of how currency depreciation affects corporate debt. The hotel generates the vast majority of its revenue in Sri Lankan rupees. Even when foreign tourists pay, those funds are often converted or localized. However, the principal of their debt is firmly anchored in US dollars.
So when the Sri Lankan rupee loses value against the dollar, the local currency cost of that foreign loan just skyrockets.
It does. If the rupee depreciates by 20%, the company suddenly needs to generate 20% more room sales just to make the exact same monthly debt payment.
That's brutal.
In accounting terms, the company is required to recognize the increased rupee value of that total loan as an immediate loss on the income statement, even if the loan itself doesn't mature for another 5 years.
Okay, so the paper loss destroys the bottom line on the income statement today, but because they aren't paying the entire loan back this afternoon, it doesn't actually drain the current operating cash flow.
Exactly. The critical danger arises when that loan actually reaches maturity. If the company is forced to repay those dollar-denominated loans while the local currency remains historically weak, those theoretical paper losses instantly materialize.
They become real.
Very real. They transform from a frustrating accounting entry into a devastating real-world cash obligation. The company must scramble to find vastly more rupees to purchase the dollars required to satisfy the bank.
This all just reinforces the fact that you cannot just trust the top line revenue. You cannot rely solely on the accounting profit, and you definitely cannot blindly trust a positive operating cash flow figure.
No. Successful retail investors must analyze all of these metrics in tandem. Positive cash flow today is a hollow victory if it is overshadowed by a mountain of looming US dollar debt and a physical property that is decaying due to deferred maintenance capital expenditure.
Right.
You must look at long-term financial obligations alongside current liquidity to truly understand the complete structural health of the asset.
Man, it really requires looking far past the beautiful marble lobby and the piano player in the lounge, doesn't it?
It really does.
Well, we started today talking about the sensory expectation of prosperity when you walk into a luxury hotel. And I want to leave you with a final thought to consider the next time you read a glowing headline about the tourism sector recovery. If a luxury property is quietly delaying its real-world maintenance spending, hiding behind the paper shield of depreciation just to survive a crushing debt squeeze today, what happens to their market share tomorrow? Think about the physical reality. When those tourists finally do arrive, lured by the macro narrative of a beautiful island recovery, and they walk past that grand lobby into a room with outdated bathrooms, peeling wallpaper, and aging climate control. What happens when they compare that experience to the brand new, unburdened competitors opening up down the street?
A strong macroeconomic narrative will never save a property from 1,000 terrible customer reviews.
It won't. The illusion always fades. Thank you so much for joining us on this forensic deep dive. Remember, the market loves a good story, but the official disclosures never lie. Always look past the narrative, verify the data for yourself, and stay curious. See you next time.